accruing your first $100,000 is often the hardest part of investing. Gains seem small and progress slow compared to working income. However, as your portfolio grows, it starts to snowball, and reaching the next $100,000 happens faster. With compounding, reaching your first million can come sooner than expected. Instead of fixating on slow progress, focus on strategies that maximize returns. In this video, we offer 9 crucial tips for saving your first $100,000, including one surprising tip that could significantly boost your budget. If you're interested in improving your financial future, be sure to subscribe to the channel and hit the like button if you find this video helpful. Tip number 9: tax planning. You might not realize it, but taxes are likely one of your largest personal expenses. If you have the opportunity to reduce this burden, why wouldn't you? Contributions to an IRA or 401k are tax-deductible, meaning you receive a tax break for using them. When you're not paying taxes on the money you're contributing, you'll reach that $100,000 milestone much faster. By investing in these tax-advantaged accounts, you'll avoid immediate taxes, accelerating your path to financial success. Your savings will continue to grow tax-deferred. For example, if an employee earned a $50,000 salary and contributed $10,000 to a 401,000, their taxable income for the year would be reduced to $40,000. Assuming all else remains equal, in 2022, most individuals can save up to $20,500 in a 401,000 and $6,000 in an IRA. This provides a significant opportunity to reduce taxable income. While Roth IRAs offer their own set of advantages, utilizing a 401,000 and IRA can accelerate the growth of your savings at a rapid pace. Number 8. Take advantage of a 401,000 match. Employer matching of your 401,000 contributions means that your employer contributes a certain amount to your retirement savings plan, based on your annual contribution. Typically, if a 401,000 is available at your workplace, the employer will match 50 cents for every dollar you contribute, up to 6% of your salary. This means for an annual income of $50,000, if you invest $3,000, your employer will match it with an additional $1,500. While this may not seem like a large amount, that match is essentially an immediate, risk-free 50% return on your investment. Number 7. Earn extra income earmarked for investments. It's no surprise that the easiest way to save and invest more money is to earn more. While frugality has its limits after all, there's only so much you can save. There's theoretically no limit to what you can earn. Consider starting a side hustle that allows you to generate additional income specifically earmarked for investing. The opportunities are endless when it comes to starting your own small business. And many of these side hustles offer flexible schedules, allowing individuals to work just a few hours on weeknights or weekends. This extra income can significantly boost your savings, bringing in more money instead of solely focusing on cutting expenses. By doing this, you can fund your investments without drastically altering your day-to-day life. This approach is crucial because it reduces the likelihood of feeling deprived, making it easier to stay committed to your financial goals. Number 6. Reinvest all dividends. When you receive dividends, it's tempting to spend them, but it's crucial to reinvest them instead. Dividends provide cash flow, but focusing on your long-term goals is key. Reinvesting dividends in the same stock or fund enhances returns. Historically, the S&P 500 has averaged a 10.7% return with reinvested dividends compared to just 6.6% without, according to wealthycorner.com. Number 5. Purchase low-cost investments. To reach your first $100,000, keeping investment costs low is crucial. Investment fees generally include trade commissions and expense ratios for index funds and ETFs. Historically, brokers charged per trade, but now many trades are fee-free due to low-cost options. Expense ratios, however, persist as annual fees for owning index funds or ETFs. While funds tracking benchmarks like the S&P 500 are similar, expense ratios vary. For instance, Fidelity's S&P 500 fund has an expense ratio of 0.09%. While Vanguard's is 0.03%. Choosing the lower cost option is wise. Number 4. Resist the urge to buy and sell based on fear. When your investments lose value, it can be unsettling, leaving you questioning whether the market will ever bounce back. In moments like these, the temptation to sell everything to limit your losses can be overwhelming. The idea of selling at the peak and then buying back in at the lowest point seems like a perfect strategy to secure profits and capitalize on discounts. However, this approach is fraught with difficulty and rarely succeeds. History shows that average investors who attempt this often miss the mark, failing to reinvest until it's too late, having already missed the bulk of potential gains. As you work towards building your first $100,000, don't let market performance dictate your actions. There will be times of significant returns and others when your portfolio is in the red. Rather than obsessing over every market fluctuation, concentrate on consistently setting aside money and weathering the market's ups and downs for the long haul. Number 3 in investing, choosing the right assets is vital to avoid significant financial losses and missed growth opportunities. Novice investors should aim for high returns but often open 401k accounts without fully understanding their options. Higher returns usually come with higher risks, but modest investments mean a failed investment may have minimal impact. Novices should avoid reckless investments like speculative stocks or unproven cryptocurrencies. Instead, they should pursue growth-oriented strategies. While experienced investors focus on capital preservation, beginners should seek substantial profits through a diversified portfolio. Investing in an SP 500 fund can offer exposure to leading companies and diversify across about 500 stocks. Alternatively, an SP 500 growth fund emphasizes growth potential. Number 2, avoiding lifestyle inflation is crucial for financial success. Many fall into the trap of increasing their spending to match their rising income, a pattern that can prevent long-term financial progress. For instance, the average millionaire saves 64% of their income. As individuals earn more, there's a common temptation to upgrade their lifestyle, buying more expensive cars and dining at upscale restaurants. This tendency for spending to rise with earnings can trap individuals in a cycle of perpetual financial struggle, hindering their ability to invest and accumulate wealth. Instead, when you receive a raise, it is wise to save the majority of it. This practice is particularly important when your investment portfolio is still growing, as the bulk of your wealth will come from your contributions rather than accrued interest. This habit is a key reason why the wealthy continue to grow their fortunes. Number 1, housing costs are often the largest expenditure for most individuals. Between rent or mortgage payments, utilities, and associated expenses, it's easy to feel as though there's nothing left at the end of the month. For those striving to accumulate $100,000, the burden of housing can be particularly daunting, consuming a substantial portion of the budget. To mitigate this financial strain, it's prudent to explore ways to reduce or temporarily eliminate housing expenses while building a portfolio. Options include sharing accommodations with roommates, staying with friends or family in mutually beneficial arrangements, or relocating to a more affordable area. Even house hacking can be achieved with minimal funds. By cutting these costs, you'll be surprised at the significant savings that can accumulate each month, which can be directed towards reaching your financial goals. Starting with these strategies can make the journey to the $100,000 milestone more manageable and set the foundation for long-term wealth creation, ensuring financial security and growth without constant concern about money. Thanks for watching. If you found these tips helpful, make sure to hit that like button and subscribe for more insights on building your wealth and securing your financial future. Don't forget to ring the bell so you never miss an update. Stay smart, stay focused, and I'll see you in the next video.